Let me introduce to you Mike Arougheti to my left, and to his left is Tony Ressler. These next two panels are going to focus on credit markets with an accent on alternatives, or private credit if you like. And to begin, I'm going to guess, because it's always dangerous to assume anything, that most people in the room don't know you guys, don't know your firm that well. It's possible that some of you may be common shareholders of Ares Management.
If you're not, by the end of this panel, maybe you will be.
There might be LPs. Some of you may know that Ares just a few months ago closed the largest ever direct lending fund in Europe, 6.5 billion euros. So perhaps you're participating or may participate as a limited partner. But again, under the assumption that most people don't know that much about Ares, why don't you guys take a couple of minutes and tell everybody what you do. I'm going to put up a slide that shows the strategies that you employ and the returns that you're targeting, and so you can make reference to that if you like.
Take us out.
So I guess I could try to take the 2-minute version. And yes, I guess we'd like to consider ourselves the best firm you've never heard of, but I don't know if that's helpful or not. Ares Management is an alternative asset manager, of course, with 3 basic pools of capital. The objective, of course, is for each of the 3 to complement the others in how they go to market, in what they're able to achieve. But we manage something in the neighborhood of 125 billion of assets, over half of it in credit, liquid and illiquid credit. I think it's fair to say that we've become somewhat well known, particularly in Europe, for our direct lending business, but we happen to run the largest direct lending business in the US and Europe. So it's been a business that we've been in for a very long time. But liquid and illiquid credit, alternative or structured credit as well, US and Europe, very substantial in the private equity business, middle market private equity, special situations, energy infrastructure, and thirdly in real estate, both private equity as well as lending. And again, I would say that if anything, we've been both benefiting from and certainly arguing in favor of the transition, and it will be part of today's discussion, I'm sure. But there is a transition of assets that once was on the balance sheet of large banks and are moving off the balance sheet of large banks, whether it's in the direct lending to middle market companies, whether it's in the direct lending to non-corporates, often referred to as structured or alternative credit, whether it's in direct lending to real estate assets and real estate owners. Again, self-originated credit products, I would say infrastructure, I would say asset-backed securities, all of which resided in different pockets of large banks. And really since 2007, 2008, for a whole bunch of obvious reasons, some less obvious, banks that have been anywhere from 15 to 40 times levered, I think both from their board's perspective, their management's perspective, I would say many regulators' perspective, that there are some assets better served off the balance sheet of banks with large institutional investors, asset managers like ourselves, versus the banking community. So that's been the history. We have grown the business since 1997 and have grown to something in the neighborhood of 2 billion to something in the neighborhood of 125 billion with offices in 14 different locations, with the vast majority of our assets invested in the US and Europe.
Mike, the word alternatives conjures for many people a list of usual suspects. Who do you think of among those 3 main pools of assets? Who do you think of as your principal competitors?
Yeah, it really depends on the asset class. Mm-hmm. So there are 6 large global publicly traded firms, each of who offer similar product suites. So if you were to drill down into the different asset classes, we're bumping into different competition. But to that point, I think what Tony remarked on, there's been a massive consolidation in the quote-unquote alternative asset space. It's being driven by changing investor behavior. It's being driven by regulatory changes in both the banking and insurance sector. It's being driven by changes in demographics. So with this growth in alternatives, you're seeing a move to scale amongst the larger managers. And when you look at something like this, 20 years ago, if you said that you were an alternative manager, it meant that you were taking an extraordinary amount of risk in illiquid assets to generate 20% plus rates of return. And that would coexist alongside a traditional fixed income or global equities business. Today, when we talk about alternatives, we're talking about a very broad spectrum of both alternative fixed income and equity strategies, running the gamut from a 4% return to a 30% return. So part of this is really just a redefinition of what it means to be alternative. And what it really means is that we are offering something that is a unique alternative to a traditional investment product to an institutional or retail investor. And because of some of the things that Tony referenced post-financial crisis, everybody now has an actuarial target, whether you're an insurance company, a pension fund, or a retiree, that they're trying to meet, and they are struggling to meet it with the traditional product. So our ability to construct unique investment products because of our self-origination capabilities around the world is really what's driving this change.
Are the forces that have driven the growth of the alternative asset business from, if I were to just take the largest firms, 7 or 8 largest firms, it's gone from, in 2007, before the financial crisis, less than $500 billion under management, today to in excess of $1.5 trillion of management. So we've seen a huge shift. But are the forces that drove that shift still in play, or has it played out?
I actually think the forces are very much still in play. Now again, there's a whole lot of reasons why alternatives have grown as a percentage of the total pie. Excuse me. But one or two of them, at least I would argue, is global equities, while they might offer, particularly in the last year or two, quality performance, but global equities offer a level of volatility that many large pools of capital, large institutional investors with required payouts, as an example, simply cannot be overly extended or exposed to. And similarly to global fixed income, which particularly since 2009, where rates have been simply too low to provide that level of payout. So because of low rates on global fixed income and extreme levels of volatility and uncertainty relative to performance for global equities. So therefore, you've seen this alternative asset class, and our job is to produce meaningful returns, sometimes by giving up forms of liquidity in exchange for higher levels of expected returns.
Why is it that Ares has, you mentioned that you have the biggest direct lending business, both here in Europe and in the United States. Why is it that your firm, more than any other, has focused on direct lending as a business? There's lots of other places you could have explored in credit.
So I think we're all frustrated bankers, so we both started our careers on the banking side, actually on the commercial banking side, and then moved into the investment banking side of things with a focus on the leveraged finance market. So as silly as it may sound, the early DNA of the firm was in the credit markets. When we started Ares, having come from a bank, there was a pretty significant epiphany, which may sound simple. We realized that working in banks actually didn't want to lend money. And so as somebody who wanted to make principal investments sitting within a bank looking to make loans, only to realize that the balance sheet wasn't necessarily open, it clued us into this huge shift that's occurred. In the US, in fairness, the shift was already in play pre-financial crisis because of a consolidation trend throughout the course of the 90s and early 2000s. We had a view that what we saw develop in the US would play out here in Europe. The financial crisis accelerated that in terms of the opportunity for a non-bank lender to come in. So a lot of it was driven just by our background and the unique position that we had in the market to identify that trend. And then I think one of the reasons we were able to accelerate that is we made very significant early investments in origination. And at the time that this asset class was developing, I think most folks that looked like us were trying to approach it from a traditional leveraged finance and capital markets orientation, and didn't really have that deep appreciation for having to have boots on the ground actually originating loans in the local market.
It occurs to me, though, that it's worth taking a moment to define what we're talking about. Direct lending is a term that gets thrown around,
Sure.
Right? It was perhaps one thing at one point. It's kind of the same thing now as it was, but the parameters around it have changed.
But there's a lot of, not to argue with
No,
my partner
by the way,
here.
we argue all the time,
even
so
though,
hopefully we'll even
but
get to see some.
I'm not sure about banks not wanting to lend. I think banks want to lend. Banks might be more
certain segment.
confident lending to the individual or to the large multinational or to the country, but to middle market companies, bank models have often.
Wait a minute. What's middle market?
Well, so middle market, at least when I started in this business in 1985, we would describe loans or high-yield bond securities in the middle market that were in that $5 million to $25 million range. And today, as crazy as this might sound to many in the room, I think we talk about the middle market being loan sizes of 15-ish million to $1 billion and a quarter, to give you a sense of loan sizes in the middle market. But the other point, and again,
20 years ago, if you were a $1 billion fund in the private credit space, you were large, and now we're actually talking about making $1 billion loans. I mean, that's a big.
And there is an advantage to being in the middle market to your borrower, knowing that one, we could make a $1 billion commitment, and two, that we're going to be here for a very long time. But the other point, and again, something that I still think is a major difference between how banks make their loans and what type of loans, the bank model is to syndicate the loan as opposed to own the loan. In the direct lending business, as they say, we eat our home cooking. You know, we're massive owners of what we underwrite and should be. And we would argue it's almost a healthier form. We underwrite, we hold. Yes, we might syndicate a portion if it is too much for us to own. But generally speaking, we're underwriters and investors and owners of these loans, where the banking model has become a syndicator and distributor. So it's a little bit of a different model. And it might be said that our type of lending generally is, if you will, whether it's riskier or whether it's to a higher multiple of cash flow than most banks are comfortable with, but we are absolutely lending 4 to 6 times cash flow, where banks are often lenders to receivables and inventories or secured lenders as opposed to cash flow lenders. So there's a different mentality.
I'm going to ask to bring up another slide just because it shows where direct lending fits on that risk spectrum of the things that you do on your platform, and we can continue. You were going to say something, Mike.
I was going to say, first of all, I love Tony's eat your own cooking as opposed to somebody saying, oh, this is terrible, try it. But direct lending, as this asset class has emerged and there's increased awareness, even today, when we talk about direct lending or private credit, a lot of people still think of it as middle market loans to middle market companies, SME lending. For us, given the scope of our business and our origination capabilities, direct lending really means self-originating a loan direct to a counterparty and owning that loan as a principal investor. And on the Ares platform, yes, we have a very large business where we're making SME loans in both the US and in Europe, but this whole debanking trend has created new opportunities for us in the commercial real estate area, where we're making mortgage loans directly to institutional owners of real estate. We're self-originating asset-backed securitizations that used to be the purview of banks. So when you ask these forces that are at play, this big debanking and institutionalization trend is still at play in other parts of the private credit market, not just the corporate lending market.
So the debanking trend, as you described it, both of you have described it, has created the opportunity for firms like yours to provide supply, but there's forces affecting demand as well, and you mentioned some of them, right? The need to, if you will, meet a return target because you have liabilities, looming. Won't that, but over the last several years, certainly in the post-crisis environment when rates have been, in the Western world at least for a period of time, and in some cases still have been at 0 or less, and we've also had quantitative easing, there's been what we've come to term the reach for yield. Isn't some of that demand for the kinds of products you're originating going to disappear as rates rise, people no longer feel the need to reach for yield?
I'll give my opinion. You can, theoretically, one would think that you'd see outflows as rates went up. We're actually seeing the opposite. And the reason we're seeing the opposite is twofold. The large institutional investors looking for spread over the risk-free rate, and self-originated private credit, broadly defined, has a persistent excess return embedded in it. So what has happened is most institutional investors have restructured away from traditional fixed income equities and high-octane alternatives to have a much broader view of alternative fixed income. And now that there's a core allocation to private credit, as rates are going up, particularly because these are floating rate assets and the total return is going up, it's actually a more effective tool to close that gap. So intuitively, you would expect outflows. We're actually seeing the opposite because the durability of that excess return is pretty significant. And then for a certain subset of the institutional investor community, as rates are going up, the value, if you will, of their embedded book is coming down. And so there needs to be a reinvestment on the short end of the curve as well. So we're actually seeing an uptick in global demand for private credit, particularly floating rate, shorter duration as rates are ticking up globally.
I try to look at the world as an investor with my personal capital as well as how we run the business. If you're in the business of buying 10-year
This is a guy who owns a sports team, by the way.
But true that. But I would say that if you're buying 10-year treasuries for 2% return and now they're at 3%, for whatever it's worth, and you believe I'd rather put a larger chunk of my capital into 10-year treasuries at 3%, for whatever it's worth, it's probably coming from my allocation to high grade or from high grade. So if you're interested in generating a self-originated floating rate senior secured credit product, and you think you could make 6 to 12% returns in those categories, whether it's in direct lending to corporates, direct lending to non-corporates, rescue lending, real estate lending, I would say that that additional 500, 600, 700 basis points of yield, different type of investor, and if anything, I think that asset class, getting more credibility in the world, is actually growing, and people are appreciating its size and opportunity.
Good question from the audience here. How has direct lending performed in recent years compared with high-yield bonds? And maybe we can exclude the past couple of weeks in high-yield bonds. And why would a mid-market player prefer the first option over the second from a liquidity standpoint?
So there's a couple of questions in there.
Yes, there are.
Generally, they have performed better on a risk-adjusted basis. The challenges over the last couple of years, high yield has outperformed in a benign credit environment, despite the fact that high yield spreads are at levels where we would probably argue they're unattractive on a relative basis. But the asset class itself has generally performed in line or slightly better. High yield, much deeper in the capital structure, taking on much greater risk, weaker covenant and security protections, longer duration, fixed rate. So the reason an investor would gravitate towards middle market credit, broadly defined, versus high yield is it's floating rate, it's senior secured, it's covenanted, it's shorter duration, and should have higher risk-adjusted returns through the cycle. One comment, though, that I don't know if folks fully appreciate, the one thing that we have seen that's a big trend is most large institutional investors that we interact with have re-underwritten their need for liquidity. And what we have seen is coming out of the financial crisis, the access to liquidity didn't actually perform the way that people wanted it to. And so people gave up a significant amount of return for liquidity that proved to be ephemeral and illusory, and they couldn't access it. So most folks that we deal with at the highest levels have gone back and said, what's my real need for liquidity? How much more of my portfolio can I allocate to illiquid assets to capture that excess return? And what private credit does is, because it's so high yielding in current pay, it's providing natural liquidity in the portfolio.
And most of our investors, and the way we manage our firm, so we have and manage a large amount of liquid syndicated loans and high yield bonds. So we have a very sizable liquid credit business, a much larger direct lending or illiquid credit business, as well as a private equity business. And comparing and contrasting all three of these areas is very important for the investor.
Value lens, yeah.
Within private lending itself, or direct lending, how does the European market differ from the US market?
It's still less banked. So this debanking trend that we talked about in the US, about 80% of the loans are getting made outside of the banking system. That number is still much lower here. So the banks are still playing a more prominent role in SME lending across Europe. The size of the markets is roughly equivalent, but as you can appreciate, country to country, jurisdiction by jurisdiction, the markets are functioning differently. Generally, spreads, fees, and total return in the European market are slightly ahead of where the US market is. I think that's a function that it's less evolved, and there's probably a perception that there's a little bit more economic risk or risk to earnings growth in the European market than in the US market currently. But the European market is very quickly catching up to the US in terms of its
And it's
maturity.
generally moving where the amount of loans on the balance sheet of banks, which is substantially lower in the US market, is similarly moving in that direction in the European market. So 5 years from now, this market, the middle market lending market, will be much larger.
For sure.
Both markets share some risks, but there are clearly some things that are distinct about what's happening in Europe economically, politically, as far as monetary policy is concerned. But I wanted to ask about two things specifically, because I suspect they interest the audience. To what degree are you, because it would undoubtedly have some effect on your business, to what degree are you worried about a bad outcome in Italy?
Well, again, right now, we don't have meaningful exposure. But to say that you're not or shouldn't be worried about a bad outcome would be a mistake. It's a sizable economy. It's critical to where Europe is and will be. So, but from our perspective, we've been substantially larger lenders, generally across Northern Europe than Southern Europe. We just found it much easier to do business in the middle market lending business across Northern Europe. And over time, we think Italy has some real issues to face and to fix, if you will, in their financial system. And it's not an overnight experience.
And how are you managing Brexit? Both as a company and as a lender?
Yeah, so clearly, as a lender and across all of our investments, we've been more cautious in underwriting UK assets. We have seen some changes in value in our core real estate holdings here. The nice thing about the way that we've positioned our business relative to some of my earlier comments, we have a pan-European footprint in everything that we do, and there has been a noticeable shift at Ares in terms of deployment, whereas 5 years ago we were probably 50% UK, 50% rest of Europe. That number has now skewed much more to the continent, just given what's going on here, some of the uncertainty, and frankly...
70-30?
It's probably 70-30 now, maybe even 75-25. And the deal flow, frankly, has slowed as the entire market is waiting and digesting the outcomes.
And are you moving your own people to Europe, out of London?
We are not, but we are growing probably faster in other parts of Europe, for sure.
Now, the other thing we need to mention when we talk about credit is the fact, and I guess it differs depending on whether we're talking about the United States or whether we're talking about Europe, but we are late or later in the credit cycle. And whenever I talk about credit, I do like to reference Howard Marks, who's been doing this credit stuff for longer than either of you guys, and happens to be a very fine writer on top of it. And Howard wrote recently, and I just want to quote his memo from last week. This is Howard Marks from Oaktree, for those of you who don't know. What the wise man does in the beginning, the fool does in the end. It seems obvious that direct lending is taking place today in a more competitive environment. More people are lending more money today, and they're likely to compete for opportunities to lend by lowering their standards and easing their terms. How do you compete in the environment Howard describes without lowering your own standards?
Very simply, you don't lower your standards. Listen, Howard, who's both a good friend and a superb marketer, and the idea, and a great investor. Again, I'm a Howard Marks fan, but to say proceed with caution late in a cycle, we agree. So the best way to protect yourself as a lender is to lend to the best companies you can find and to maintain your standards and not to stretch for yield in markets like this, but to stretch for quality. And again, the best protection, frankly, away from staying in cash, which we are not paid to do, is to increase the quality of the assets that you're exposed to, be utterly obsessed about the quality of your portfolio.
And accept lower returns.
And accept lower returns and even better covenants on occasion when it's possible to trade covenants and protection and seniority for yield. So yes, to suggest that you proceed with caution, to me, is a statement of the obvious. but to suggest that you are obsessed about the quality of your portfolio at this particular time in the marketplace with the number of new competitors, it's what we get paid to do.
Well, the new competitors issue surely must be a problem, right? I think the analogy I think of is the undiscovered slice of beachfront paradise, right? And then the tourists show up and it's no longer such a slice of paradise.
You do this business long enough, the number of new private equity players, the number of new credit players, the number of new alternative credit players, the number of new hedge funds that pop up, the folks that are really good at doing something with enough capital to withstand all sorts of market adjustments will be in business 5 and 10 years from now. Many of the folks coming into the market now, which I think Howard is absolutely accurate in describing, may not be here in the market downturn or through the market downturn. And
you'll see more dispersion in return, but back to the beachfront property, if you already own a large swath of beachfront property, that's pretty good. And the reality is one of the biggest protections we have, aside from the risk filter we put in place, we have investments in 1,500 middle market companies. In the US middle market lending business, 75% of the investments we made last year were to companies that were already in our portfolio. And in Europe, that number was about 40%. So the barrier to entry when you have these big embedded portfolios and years-long relationships with these companies, much easier to re-underwrite and make a loan to a company that you've been following, that you have a relationship with for 10 years, than to have to go into the market and try to find that slice of property. And I think that incumbency effect is probably misunderstood and underappreciated by a lot of people who are looking at the asset class.
Eric, you mentioned it earlier, and you could say it over and over, but now is your time to reaffirm your commitment to quality as opposed to your effort to find yield. And that's what we get paid to do.
Gentlemen, I'd like to thank you very much for joining me here.
Appreciate everybody.
Mike Arougheti and Tony Ressler.
Thank you.